Thank you for joining today's webcast entitled The Fallacies of Asset Allocation. My name is Hank Kim, and I'm NCPERS Executive Director. Today's program is part of our Center for Online Learning, which provides remote, continuing education to public pension trustees, staff, and other fiduciaries and stakeholders. As the global economy prepares to emerge from the COVID pandemic, investors around the world are taking a fresh look at their asset allocation. Drawing on insight from a forthcoming book entitled Asset Allocation, From Theory to Practice and Beyond, this presentation explores some of the most persistent misconceptions about asset allocation. Today's event is sponsored by State Street Corporation. State Street is one of the world's leading providers of financial services to the institutional investor space. With nearly $39 trillion in assets under custody and $3.5 trillion in assets under management, State Street operates globally in more than 100 markets and employs approximately 39,000 workers worldwide. It offers a fully integrated array of products and services to support sophisticated investors in developing and executing their global investment strategies. Leading us in our discussion today, we have with us Will Kinlaw. Will is Senior Managing Director and Head of State Street Associates, a partnership that bridges the world of financial theory and practice. Will oversees the development of investment indicators and research, which are delivered daily to thousands of investment managers, pension funds, sovereign wealth funds around the world. Lastly, before I turn over the program to Will, we do want to make these sessions interactive. So if you have questions for Will or have comments about this presentation, please submit them by using the chat function on this platform. So at this time, without further ado, Will, let me turn the program over to you.
Great. Thank you so much for the introduction, and thanks for the invitation to come here today. I'm really excited to talk about asset allocation. It's been the major focus of my entire adult life. For about 20 years, I've been talking about it, thinking about it, listening to others talk about it, writing about it. So I'm going to try to share today a little bit on two parts here. So the first part is going to be a little bit of a review of the fundamentals, just to get us all on the same page, how to think about modern portfolio theory and what is an asset class and what is asset allocation all about. And then the main part of the presentation will be the fallacies. So I want to be clear up front, this isn't meant to be a comprehensive treatment of asset allocation. What my goal is today is to help you get ahead of some of the major misconceptions that are really persistent, that are out there, that even really sophisticated investors have about asset allocation, and prepare you to address those. So as I go through each fallacy, what I'm going to try to do is give you a sense of why it's a fallacy, what's wrong with this concept, and some good questions to ask. If you're in a board meeting or an investment committee meeting and something comes up, what sorts of things can you ask to get to the bottom of the issue that you're being presented with? So with that, let's dive right in. I'm going to just show you a few slides again on some fundamentals, and I recognize this will probably be review, but I still think it could be helpful just to get us on the same page. So let's start with what is an asset class. Now, before we can allocate them, we have to define what they are, right? And all of these definitions are relative, but my co-authors, Mark Kritzman and David Turkington and I, when we think about what really defines an asset class, these are the 7 criteria that we think about. So let me just quickly walk through these. First of all, its composition should be stable. So for example, if you take a big basket of stocks that are all momentum stocks that have been rising recently, you can't really define that as that group as an asset class, because when something changes and their trajectory shifts, the composition of that group is going to change overnight. So it should be a stable composition. The attributes that make it, defining of the asset class should be relatively stable. Number 2, it should be directly investable. So for example, inflation is not an asset class. You can identify assets that are designed to hedge against inflation, and that's fine, but inflation itself is not an asset class because you can't invest in inflation. Third, the components in the asset class should be similar to each other. Now, this is a really relative term, right? Because many investors would treat US stocks as an asset class. And that includes companies as varied as Exxon and Microsoft, right? Which are clearly very different companies. But relative to other types of investments and securities and the full universe of everything we can invest in, there's enough similarity between those. They're both equity asset classes. They're both large companies. They're both US companies that many investors could get comfortable they belong in the same asset class. But there should be some defining similar characteristics within the asset class. Number 4, things in the asset class should be dissimilar to other asset classes, as well as other combinations of asset classes. So that's just kind of the inverse of number 3. Number 5, when you add an asset class to the portfolio, it should raise the expected utility of the portfolio. So we'll talk a little bit about what utility means. It's kind of a theoretical concept, but basically you can think about it as risk-adjusted return. So if you're adding an asset class to a portfolio, it should be because it's raising the return, or it's reducing the risk by diversifying something, or perhaps both, which would be really nice. Number 6, an asset class shouldn't require skill to identify managers within it. Now, this one is a little bit controversial. So my co-authors and I don't view, for example, hedge funds as an asset class. They're often treated as an asset class, but they're not really an asset class because you have to have good skill in picking the right managers to put that group of hedge funds together. On the other hand, private equity would be an asset class because with private equity, there's tons of research showing that even median managers outperform public equity market. Number 7, finally, it should have enough capacity to absorb a meaningful fraction of the portfolio. So this means that what could be an asset class to one investor is not an asset class to another. Think about fancy art, high-end artwork, right? For a wealthy individual, that could be an asset class. They could put 5, 10, 15% of their wealth into art. But for a big institution with billions and billions to invest, art isn't going to be an asset class because there just won't be enough liquidity to take on a big share of the portfolio. So this is helpful because before you can engage in asset allocation, you've got to narrow down the menu. What are the things we're allocating across, and how do we define those things, and how do we decide if something's an asset class or not? And look, I admit there's a lot of gray area here, right? These aren't black and white definitions, but it's a good framework to think about things. One asset class should never subsume 2 other asset classes completely. That doesn't make sense, right? So it's helpful to think about this list. So from there, let's go on to the major theory that guides asset allocation, which is modern portfolio theory. And the whole actual discipline of modern finance is relatively new. In 1952, a Nobel laureate named Harry Markowitz published this paper called Portfolio Selection, which was all about how to combine assets efficiently. And that paper, basically, it's referred to in academic circles as the Big Bang of finance, because it basically started the entire discipline. And what Markowitz argued was that when investors build a portfolio, they shouldn't do it to maximize return, because this ignores risk. What they should do is maximize the return for a given level of variance. And variance is a statistic that measures risk. And he introduced the notion of diversification, that if you combine uncorrelated securities, you can lower your variance, all else equal, without necessarily lowering your return. So in that paper, he called this the EV maxim, which is the expected return variance maxim. Today, we call it the efficient frontier, and it's the cornerstone of modern portfolio theory. So let me show you a very simple example, and you don't need to look at these numbers. I'm just putting these up here as an example, and this is taken from our book. So if you're interested, you can look in there for a lot more detail. So here you have 7 asset classes. These are US asset classes, but the same framework could be used globally. And we use an equilibrium return model. So we come up with expected returns that would compensate for the risk that each asset class introduces to a portfolio. You may end up tweaking some of your expected returns. Maybe you or your investment consultant think that a certain asset class is undervalued. It's going to perform better than its risk would suggest. In that case, we've done that here for commodities. But at the end of the day, you need to have a rigorous process to come up with some expected returns. Next, on the lower chart, the lower table here, you have standard deviations. So standard deviation is just a statistical measure of risk. How volatile is the asset class? Stocks are more volatile than bonds, for example. In many cases, bonds are a little bit more volatile than real estate, depending on the type of real estate, right? So you can think about standard deviation as really just a measure of dispersion in returns and risk. And then on the right side of this table, you have correlation. So correlation goes from -1 to 1. The higher it is, the more the assets zig and zag together. The lower it is, and if it becomes negative, they actually tend to move in an opposing direction. For correlation, all else equal, is good. That's what we want. It means we're getting some diversification. It means that if both things have positive returns, but they tend one zigs when the other zags, that you're going to have a less volatile portfolio. So again, very simple stuff. These are the basics of asset allocation. If we take this sort of information and put it together, we can produce an efficient frontier. And that's what's being shown here on the left side. So the efficient frontier is a really simple idea. Basically, it shows the most amount of return given these assets and all the assumptions I just showed you. No matter how we combine them, all the different ways we could combine them, we can't get a return higher than this line for a given level of risk. That's all it's saying. So each of the points along this line in this continuum is a portfolio. It might be 20% US equities and 10% foreign developed markets and so on and so forth. And that particular portfolio has a certain return and a certain risk, and it falls along this frontier. Now, what we've done in this table on the right is we picked out 3 of those portfolios. A conservative one that's kind of down to the lower left, a moderate one, which is kind of in the middle of the frontier, and an aggressive one, which is on the upper right. So as you'd expect, the aggressive one has a much higher return, but it also has a higher risk. And you can see the allocations make sense. The aggressive portfolio holds a lot more equities than the conservative portfolio. Now, one of the tricky things here, when you put all this information together and you come up with your efficient frontier, one of the really tricky things is figuring out which one of these portfolios is right for us, because they're all technically optimal. So which one, well, put it this way, I shouldn't say optimal. They're all efficient. They all offer the most return possible for that level of risk. But which one is optimal for a given investor? Now, according to theory, that depends on something called risk aversion. Risk aversion is a number theoretically every investor has one, and it's the amount of return they're willing to pay to give up in order to reduce their risk by 1 unit. So if your risk aversion is high, that means you want a really conservative portfolio because you'll give up a good amount of return just to reduce your risk. If your risk aversion is low, the opposite is true. Now, in practice, nobody, including me, knows their risk aversion. It's not a number that people know. There's no blood test for it. It's not genetic. It's just a theoretical construct. So in practice, what investors do is they look at some of these portfolios along the efficient frontier, and they look at what sort of outcomes might we expect given the risk of this portfolio and the expected return of this portfolio. Over a 5-year period, a 10-year period, a 20-year period, what's the probability we're going to exceed a certain wealth threshold? Or what's the probability we're going to find ourselves with losses greater than a certain amount? And by comparing some of those sorts of really intuitive pieces of information about the different portfolios, typically through discussion, you can arrive at one that makes sense for that organization. So in just a few slides there, I've vastly oversimplified the entire process of asset allocation, modern portfolio theory. I've left out a lot. This was probably very basic, so I apologize for being so basic in this coverage of it. But I wanted to get us all on the same page, because what I want to do now is start to talk about where things can go wrong, because this is the theory. It's all very clean, it's all very neat, but when theory meets the real world, a lot of times things happen and we have to make adjustments. We have to address these real world complexities. There's a great quote I'm sure you've heard by the American baseball player, Yogi Berra, that in theory, there's no difference between theory and practice, but in practice, there is a difference. And that's very much the case with asset allocation. So I'm going to walk you through some fallacies here. And again, this isn't comprehensive. This keeps happening. There we go. We should be on fallacy number 1. There we go. This isn't comprehensive, but these are some of the biggest ones and some of the most persistent ones. So what I'm going to do for each of these fallacies, and I have 8 or 9 of them, I'm going to tell you what the fallacy is. I'm going to tell you why it's a fallacy. And then I'm going to tell you questions to ask when you think that you're being presented with this fallacy in your role as a trustee. So here's number 1. The first fallacy is this idea that conventional risk measures tell us the likelihood of loss or the amount we could lose during the investment horizon. This is wrong. Let me explain why. If you go into Finance 101 or you take the CFA exam and you learn about a measure like value at risk. Value at risk is a simple risk measure. It tells you, given a certain probability, this is the most that your portfolio could lose over, say, a 1-year period. Here's the problem with it. It tells you the most that you could lose with that probability at the end of 1 year. It doesn't tell you anything about how much at any point during the year that portfolio could be down. This is a huge mismatch because as investors and as board members, we don't meet just once at the end of the year or the end of the 5-year or the 10-year period of our investment horizon. We meet regularly and we're monitoring performance regularly. We perceive risk in a very continuous way, but risk measures don't capture it that way. So it's really important to think about what is during the horizon, given this strategy, given a reasonable probability, what's the most we think we could lose? What's the most we think we could be down? This is super important for setting expectations because it tells you that there is a reasonable chance of suffering a big loss. The potential chance of loss within the horizon is by definition always greater than the chance of loss at the end of the horizon. Because sometimes you lose a certain amount, say you lose 20%, and then you recover before the horizon's over, right? So the within horizon probability of loss always bigger than the end of horizon. And it's really important to align expectations because if you embark on a strategy and that strategy has a good chance of losing 20% at some point during 5 years, when you get to that point, year 2, and you're down 20%, you can say, you know what? This was part of the strategy. We knew this was possible. We need to stay the course. If we're a lot more than that, then we have to start thinking, okay, where did we go wrong? Did we make a wrong assumption? Do we need to revisit this? Do we need to take action? So when you're presented with risk measures that have a horizon attached to them, you got to understand, is this what could happen just at the end, where we could find ourselves at the end, or is it what could happen along the way? What kinds of events might we expect? What kinds of drawdowns might we expect along the way? And how will we as an investment committee or a board react to those? So that's the first fallacy. The second fallacy, this has to do with liquidity risk. So the fallacy is that our institution has positive cash flows, so we don't have to worry about liquidity risk. So let me explain what I mean here. Liquidity risk is the category of risk that has to do with committing assets to things that lock them up and what that does to the investor's ability to meet cash demands or do other things. So for example, if you invest in a hedge fund that has a 5-year lockup, can't get your money back for 5 years without paying a huge penalty. Or you invest in a private equity fund that may run for 7 or 8 years before you get all your capital back. You're locking up your capital and it's becoming illiquid in the portfolio. Now, some investors who are in the really enviable position of having net cash inflows. So their sponsor, or for whatever reason, they're getting in more cash every month than they're paying out in benefit payments and other things they're doing. They often say, we don't have to worry about liquidity risk. We have enough cash every month to meet our demands. This is a fallacy. It's not true. And here's the reason. Liquidity isn't just about meeting cash flows. That's a huge use of liquidity. But liquidity also enables investors to do other really important things. For example, there's tons of research and common sense suggesting that regular rebalancing of your portfolio, just if you've got a 60-40 mix, very simplistic example, but say it's a 60-40 mix of stocks and bonds, every month, every quarter, every year, bringing it back to that 60-40. There's huge benefit to that. However, if a good chunk of your portfolio is locked up and that valuation of that thing that's locked up starts to drift, your ability to rebalance is hampered. If you have skill or your managers have skill in tactically allocating the portfolio, but part of your portfolio is immobile, your ability to generate extra returns through those tactical movements are hampered. When your portfolio is immobile, you can't react to new information as easily. If new information comes along, you want to change your strategy, you can't do that as easily if part of your portfolio is locked up. So the point is, liquidity risk is really important. Whenever you're locking up capital, you should be asking, how long? In what scenarios might we need it back? And what would that cost us to get it back? What's the opportunity cost of locking it up? What are we giving up by submitting our capital into this illiquid strategy? And most important, do we think we're getting enough return to compensate us for that illiquidity? And why do we think that? Now, I'm not at all advocating that illiquid assets don't make sense. Of course they do. In many cases, they have higher returns. There's a lot of evidence that there's a premium for liquidity, but it's really important to understand the implications of locking up assets in illiquids. So that's fallacy number 2. All right, number 3. This is probably my favorite fallacy. The fallacy is that diversification is always desirable and is symmetric, no matter whether returns are positive or negative. Now, modern portfolio theory assumes this, and most risk models assume this, okay? Diversification is not always desirable. Think about it. When the main engine of growth in your portfolio, which is typically domestic equities, is shooting the lights out, you don't want diversification. You want everything to go up together. You want unification. You want the opposite of diversification. But when things are going poorly and the main growth engine is performing poorly, that's when you want diversification. Now, here's the other thing that makes it even more complicated is that most pairs of assets, take stocks and bonds, if you look at their correlation, this is the statistical measure of diversification, how they move together, tends to be asymmetric in the sense that it's different when the returns are high versus low. In theory, it should always be the same. In theory, correlation is correlation. If it's a nice, normal, well-behaved bell curve distribution, there should be no difference upside and downside. But in practice, there's often a huge difference. And it's usually in the wrong direction. So usually what happens is you get more diversification when you don't need it, and you get a lot of it you get diversification when you don't need it, and you lose the diversification when you do need it. Correlations tend to go up on the downside. They tend to stick around on the upside. There's this great quote, which has been attributed both to the poet Robert Frost and to the author Mark Twain, that a banker is a fellow who gives you his umbrella when the sun is shining, but then asks for it back the moment it begins to rain. And it's a great quote for thinking about diversification because it's exactly what it does. It tends to stick around when you don't need it and disappear when you do. So what can you do about this? You've got to figure out and ask questions about the main growth drivers. What are the biggest assets in our portfolio? And how are we selecting other assets to diversify those? And if we think we've got good diversifiers, because we see low correlations in a chart, have we really stress tested those correlations? Are they going to be there when we need them to be there, or are they just going to be there on average, or kind of be there when everything's going up when we don't need them to be there? Is there an asymmetry there that we need to think about? Have we stress tested that? Those are the sorts of questions that you should be asking. And all else equal, if you can find pairs of assets that offer more diversification on the downside and more unification on the upside, that's great. They're rare, but they exist. Usually, treasury bonds have a really favorable correlation profile with most assets. Treasury bonds tend to diversify very nicely during crises, as you'd expect as a safe haven asset, and can be more correlated with some assets on the upside. But those are rare and they're hard to find. Now, before we get into fallacy number 4, I'd like to go to a polling question. And I might need some help from the organizers. I'm not sure how I pull up that polling question.
So I've already sent out the polling question.
Oh, great.
I can close it if you want the results.
That's great. Do we have, how many people have responded?
12.
That's great. Let's just disclose the results, please. Thank you, Amanda.
Okay.
Maybe we'd focus first on the first polling question. So to see those, I see. Okay, I go to surveys. Okay, great. All right, so the first polling question was, the correlation between emerging market stocks and US stocks is approximately what? And there are 4 choices: 0%, 35%, 70%, or all of the above. Now, most of you chose, still some results coming in here, but it looks like most of you chose C, which is 70%. That is a very good choice. In my experience, I took the CFA exam. I've taken a lot of multiple choice tests over my life. In my experience, C is almost always the right answer. So I think that was a really good choice. In this case, the right answer is actually D. All of these answers are correct. Now, how can that be? How can that be the case? This is another fallacy, and I'm going to come back to this. Fallacy number 4. Fallacy is, it doesn't matter what frequency of returns we use to estimate risk and correlation. Daily, monthly, quarterly, it's all the same. This is wrong. So in theory, it wouldn't matter. In theory, if everything was nice and normal and nice normal distribution, and US equities and emerging markets equities had a 35% correlation. If you measured it on daily data, you'd get 35%. If you measured it on monthly returns, you get 35%. Yearly, 3-year intervals, 35%, 35%. If you went down to 1-minute intervals, it should be 35%. In practice, it's not the case. Not the case at all. In practice, you can, even if you're using the same period of time, maybe you're using the same 20-year period. So it's not different data. It's just the intervals you use. And in practice, you can get very, very different answers. So in the polling question, actually, if you look at 3-year outcomes, the correlation is 0. But if you look at monthly outcomes, the correlation is about 70%. So it's a huge difference. And the point is that the drivers of markets are different over different horizons. So when you're measuring diversification and you're trying to understand how assets diversify one another, you've got to make sure that you've looked at a few different time periods. And particularly if you're a longer term investor, you've got to look at some longer intervals, because you don't care if you're a long-term investor and your investment horizon is measured in many years. If things diversify each other well over a period of a month, but not well over a longer period, they're much less interesting to you. But what's amazing is so much of our industry uses monthly data to estimate these things, and just assumes that that same diversification, that same correlation will prevail over longer periods, and it's just not the case. So this is a really important one. This one is embedded in risk platforms everywhere. It's even embedded in the performance standards that all managers have to follow when they report their performance. So if you're a hedge fund manager, a real money, an investment manager, and you're reporting your Sharpe ratio, risk-adjusted performance, to your investor, you have to use monthly data to estimate your risk, and you have to use a simple rule of thumb with the square root of 12 to convert it to annualized risk. And that can be super misleading. We found that a lot of hedge funds actually switch from top quartile to a lower quartile when you measure their risk over longer horizons. So it's super important to think about what is our horizon and how do we think things will diversify over longer horizons? And is there evidence that their longer horizon diversification properties are different than their short-term properties? If you're shown data that's based on monthly returns, you got to start probing, you got to start asking these questions. Here's another great example. Take REITs, real estate investment trusts, right? They're publicly traded real estate companies. On a monthly horizon, they have a really high correlation with stocks, the S&P 500. It's like 60, 70%. On a 3, 4, 5-year horizon, actually much lower correlation with stocks and a much higher correlation with direct non-listed real estate. So you can come to very different answers, again, just based on this interval length. It's so important, and most of our industry ignores this. So I definitely encourage everyone to think about this one when it comes up. All right, number 5. This one is another one that's going around. So this is the fallacy that asset classes are old-fashioned, that we should instead use building blocks called factors, and that these are better for constructing portfolios. So what is a factor? Factor is a fundamental driver of risk and return. So some will argue that instead of grouping your assets by stocks and bonds and foreign stocks and commodities, that what you should do is you should build factor buckets. So for example, you might have a value bucket, which has in it everything that looks value, that has a value property to it. You might have a momentum bucket, which is everything that's been going up recently. You might have an interest rate bucket. So different ways of grouping things. And what proponents of this strategy will argue is that you can get a better portfolio, that basically you can get more return for the unit of risk. And part of that argument is that they say these factor buckets have lower correlation than traditional asset classes. Now here's the problem with that. At the end of the day, no matter how we group things, we can put them in whatever buckets we want based on whatever criteria we want. But at the end of the day, we have to invest in securities. We have to invest in the same underlying universe of assets. And we can't magically create new and more efficient portfolios just by grouping them differently. That's a mathematical fact. Furthermore, when you want to track a factor, like say you have a factor called inflation, you have to come up with a bunch of assets that are going to track that factor. And those might change through time. So you've got this mapping error. You've got to constantly be updating what's in that bucket. And our research has shown when you put all this together, you actually end up losing more than you gain. Now, that's not to say that it's not useful to think about factors. Factors can be really helpful. They can help you break down and understand what are the fundamental drivers of risk and return in this asset. So take corporate bonds, for an example. Corporate bonds have a couple of big factors that drive their returns. One is interest rates. Interest rates is a big factor for all bonds, but another is credit. There's credit risk tied to corporate bonds. And those two factors behave very differently. Credit risk is highly correlated with equities. The interest rate factor is often uncorrelated or negatively correlated. So factors can be useful for breaking things down, for understanding risk. Some of them even have premium. So for example, there's a size premium, there's a value premium. Those things can offer nice returns. But we don't believe it makes sense to completely change the way that you build portfolios and that completely change the building blocks of portfolios. So that's number 5. Number 6. So this fallacy is that currency returns wash out in the long run. So currency returns are zero in the long run. So we don't need to hedge or even worry about the currency exposure in our portfolio. So here's why this is a fallacy. It might be true that currency returns are zero in the long run, although there are some examples, pretty stark examples that suggest that's not true. But let's just say for a moment it is true. There's zero over a 40-year period. Even so, this can take a long time for these returns to wash out, and a lot of interim risk is introduced to the portfolio, and oftentimes that risk isn't compensated with return. So we argue that investors should only be retaining currency exposure if it's diversifying other things in their portfolio, if it's helping reduce risk. The thing about currencies for most investors that makes them different from stocks and bonds and real estate and other assets is that most investors don't have a view on currencies. They're not holding a lot of yen or pound denominated assets because they think the yen and the pound are going to go up. They're holding them because they liked the company. They liked Toyota. They liked British Telecom, whatever it is. And as a byproduct of that decision, they end up holding currency. So they've got it in their portfolio. They didn't necessarily seek it out. It's there. The only reason they should hold it if they don't have a view on it is if it's reducing their risk because it's diversifying other stuff. So our argument would be, look at the currencies, figure out which ones are diversifying, which ones aren't, and they're pretty different. Some currencies tend to be real great diversifiers and others don't. So you got to look at them case by case. You got to think this through. And we would argue, hold on to the ones that diversify and hedge out the risk of those that don't diversify. Now you got to think about the costs of hedging. You got to think about the complexity of hedging currency risk, but it's an important question to answer. And the notion that we can ignore it, while it would be nice, is a fallacy in our view. So now we're going to go to number 7, and I want to go to the second polling question, if I could. And that is, the question is, a portfolio becomes less risky if you hold it for a long time. And the choices are true, false, or it depends how you define risky. And this is great. The 72% of the respondents here chose C, which is that it depends, which is exactly the right answer. So this fallacy, number 7 here, is the fallacy that time diversifies risk. And this topic is super complicated. This is like one of the most complicated topics in modern finance. Nobel laureates have had major disagreements about whether or not time diversifies risk. And in fact, one of the famous economists at MIT, Paul Samuelson, at one point became so frustrated, and he was trying to prove that time does not diversify risk, that he wrote an article, which he published, that had words of only one syllable, arguing that time does not diversify risk. It's a great article, and it's a quick read, so you can read it pretty quickly. But here's what it comes down to, and there's actually another great analogy that can help you wrap your head around this. So the story goes that there were 2 professors at MIT who were arguing about this issue. And one of them offered the other one a bet. He said, I'm going to give you a coin that's loaded, so it's more likely to flip heads than tails. And if you flip heads, then I'm going to give you $100. But if you flip tails, you're going to have to give me $100. Now, look, that's a great deal. The expected return of that trade is positive because it should flip heads, and there's a nice gain if it flips heads. But the problem is the other professor said, well, I can't afford a $100 loss. I'd love to win, but even though it's a lower than 50% chance that I'd lose, I can't bear that risk because I can't afford to lose $100. But he said, what I will do is I will take your game if you let me flip the coin 100 times. Now, here's the problem with that. It's true that if you flip the coin 100 times, the most likely scenario is that you end up getting money, because there's a more than 50% chance you get heads, and if you get heads, you get $100. That's going to happen more often than you lose $100, so you should end up at the end of the 100 flips with a pot of money. The problem is, it's possible you could lose all the flips. And every time you flip, the total amount that you could lose potentially goes up by $100. So the distinction here is between the likelihood of losing and the magnitude of the loss if it happens. These are different things. You can have a 10% chance that your portfolio will lose money over a given period, and the potential, likely size of that loss if you lose money could be, 20% of the portfolio, or it could be 50% of the portfolio. They're different. Likelihood and magnitude are different, and you have to think about both. And this is where time diversification gets confusing, because it's true that the likelihood of loss goes down as time increases, but the potential magnitude of loss continues to go up as time horizon increases. Now, this still means investors with long horizons should still bear more risk. There's a lot of good reasons to bear more risk over longer horizons. And the main reason is because most investors have the ability to change things around. If they lose a lot of money in the portfolio, they can reduce the amount they're withdrawing from the portfolio for a while to let it recover, or they can maybe even contribute to the portfolio. So the things they can add or subtract to it, they're going to help the portfolio recover. But they need to recognize that the potential magnitude of loss continues to go up as time goes on. So when you're presented generally with risk measures or estimates of amounts that could be lost, it's important to understand the distinction between the size of the loss and the probability the loss is going to happen, and thinking about both. And what are we going to do as an organization, as an institution? What is this board going to do if we suffer a loss over a certain size? Is it expected? Are we going to stay the course? Or is there some sort of action we're going to have to take? And what would that look like? All right, let's move on to fallacy number 8, which is the last fallacy that I have here. There's probably other fallacies, but that's the last one I have. Fallacy number 8 is the notion that everything we've just talked about, modern portfolio theory, optimization, the efficient frontier, is all useless, and that portfolio optimization is a waste of time, and we should just use much more, straightforward kind of subjective approaches to coming up with how we allocate our portfolio. Now, there's a lot of folks out there who argue this, and there's a lot of different ways that they argue it. So I'm going to cover a few of them for you. One is the garbage in, garbage out criteria. So it's true. If you use an optimization tool and you make your efficient frontier and you put in expected returns that are completely wrong, you're going to get a portfolio that doesn't make any sense. Garbage in, garbage out. But that's not a criticism of the tool. That's a criticism of the inputs. If you're taking a trip to the beach on Saturday and you put into your GPS and you put in the address of your office, you can't blame the GPS for taking you to the office. The tool worked fine. It's that you didn't have good inputs. And there are many straightforward ways, and we've done research on this, that even the most simple inputs can add value. Even if it's long-term historical numbers or if it's risk-based numbers, without having a lot of foresight, without having a crystal ball, you can add some value with using some straightforward ways of coming up with it, the inputs to optimization, and do better than other approaches. An alternative that's often put forward is just equally weight the portfolio. So a lot of people do this, by the way, in their 401k. They're presented a menu of 12 options, and they just put 1 over 12, whatever that is. I can't do that in my head, but they put that amount in each asset in the menu. That approach has a lot of drawbacks too. Some assets are really similar to each other. You're basically just you're not making any attempt to think about the risk of the different asset classes. You're basically transferring all of portfolio construction into the menu items that are available, and deciding what goes on that menu. And that doesn't make any sense. And what we've found is that even using simple inputs, optimized portfolios tend to outperform equally weighted portfolios. There's also this notion that there's hypersensitivity, so that if you use an optimization tool and you have an expected return of US equities at 7%, and then you change it to 7.1, the whole portfolio changes in a huge way. That is really hype. That's not really true. If you construct your portfolio well and you have asset classes that are relatively dissimilar, remember going back to the criteria for asset classes, if you have asset classes that aren't super correlated to start with, you will not find that your results are hypersensitive. Another critique is that it assumes a normal distribution, this whole approach. And that if you have fat tail events like the global financial crisis or the COVID drawdown that are kind of big events that are outside what you'd expect in normal distribution, that modern portfolio theory falls apart. This criticism is also overblown. Many people don't know this. Modern portfolio theory actually doesn't assume a normal distribution. It assumes an elliptical distribution, which just means it can have very fat tails. It just can't be skewed. But in any event, in the vast majority of cases, it's a pretty robust tool. You just have to think about some of these fallacies, some of these issues that I've raised, and make sure you're asking the right questions. You're not going to take an optimization tool and it's going to say, 68.2% in US equities, and you're going to go do that. You're going to ask some good questions. You're going to tweak the results based on good judgment, but it's a good starting point. So again, questions to ask. What are the inputs to this model? How did we come up with these inputs? Do we believe these inputs? Do we believe the assumptions behind the model? Have we stress tested these inputs for different types of markets, like crises? What happens during those periods? What if our assumptions are just a little bit off? Does that completely change the outcome? Does it mean we should be doing something different? And if so, why or why not? So those are some of the things that I would recommend asking. So I'm 42 minutes in. I can talk about asset allocation all afternoon, but I recognize that folks probably have things to do, and I'd also be happy to take questions. Again, I don't think, I didn't intend for this to be comprehensive. These are some of the fallacies that we wrote about in our book. I chose them because we talk to hundreds of investors every year, most of them very sophisticated. These are pretty widespread, and there are things that we think bear mentioning and kind of keeping in mind when you're talking about an asset allocation, or as an institution or a board, you're deciding which asset allocation to go with. So I hope I've left you with a few concrete ideas and certainly some questions and where you can probe further. I'd be happy to take any questions.
Great. Thank you, Will. And there are a few questions here. First question is, why do you omit the cost of FX hedging from consideration?
So I actually did mention in there that in the questions that we need to think about the cost of hedging. And that's a very valid point. The question, when you think about currency hedging, there are a couple of different costs to think about. The actual transaction cost of trading the currencies is minuscule, particularly because for most investors, the vast majority of their portfolio is going to be in big currencies like the euro and the pound and the yen. And those things are very liquid and very easy to trade. So the cost could be in paying a manager to manage it for you. The cost could be in the fact that you have to, usually you implement a currency hedging strategy with forward contracts. So you have to, those have settlements every quarter typically, and you have to come up with cash, or you receive cash based on those settlements. So you've got to think that through. And what I wanted to get across, if I go back to that fallacy, here it is. Whoops, what happened there? Here we go. Yeah. So how much will hedging actually reduce our risk? So and is it worth it? So that's what I was trying to get at there, was the cost. I guess I didn't say cost explicitly, but what I would do is I would say, look, are we really going to meaningfully reduce our risk if we hedge 20%, 30, 40, 50% of our currency exposure? Do we think it's materially going to change the risk of the portfolio, or is it going to be a tiny change in the risk and we're going to end up paying a lot? That's a judgment call. So I totally agree that cost is a consideration.
Great. Thank you, Will. Another question. Do you recommend liability-driven investing in building asset allocation for pension plans? For example, many plans are mature, where the majority of liabilities for the plan are for retirees.
Yeah, that's also a great question. And, it's really interesting. Liability-driven investing, using that framework, is very common and popular in Europe. You see it particularly among public plans in the US. You do not see very much of that sort of analysis. Corporate plans, you'll see it more, where they're trying to inoculate a liability. Absolutely, in many cases, it makes sense if you're trying to hedge out, completely hedge out, or to manage your risk against the liability stream. All of the points that I've made here are still going to apply. Here's what's going to happen. The main change is going to be the definition of risk. And I'm just going to go backwards here to that efficient frontier. So, moving on me. So here we go. So, see if I can make it stay. There we go. So the horizontal axis here is standard deviation. And the way we've defined it is absolute returns. Now, in a liability-driven context, you would define that as standard deviation of the surplus. So standard deviation of the portfolio net of the liabilities. And then you'd apply all these same tools. What you're going to end up with is higher fixed income allocations. One of the challenges, I think one of the challenges for a lot of the public plans in the United States is if they were to pursue a liability-driven approach and they're not well funded, there's really no hope of the expected returns are going to be lower because they're going to hold more fixed income and less equities to inoculate those liabilities. So the probability that they're going to climb out of their hole if they're unfunded is pretty low. For some corporate plans and certainly some public plans, if they're very well funded or close to being fully funded, it can make sense. But that's the trade-off you have to make is do you actually have enough capital to hedge the liabilities?
Great. Thank you, Will. Another question. Hold on. Can you discuss risk budgeting as an alternative approach to asset allocation?
Yeah, so I think risk budgeting is a great approach, and I actually see the two as complementary. The way I would think about risk budgeting is this whole approach of asset allocation is a way. So there's two different ways to think about risk budgeting, right? One is the overall portfolio. We can say as an organization, we have a certain risk tolerance. We're willing to, a certain amount of loss we can envision suffering over a 1 year, 5 year period. That's our risk tolerance. And then we're going to construct a portfolio to give us the most return possible for that amount of risk tolerance. Risk budgeting can also be thought of as, okay, say that risk tolerance is that we can run at a standard deviation of 12%. Okay, great. So how do we take that 12% and then allocate it across various assets? That is just the other side of this coin. The way that you would then go about efficiently allocating that 12% is using this approach. You might just present the results a little bit differently, but this is the most efficient way to allocate a risk budget, if that makes sense. But I think it's absolutely a smart way to think about it. And if you go back to what I was saying earlier about, how do you pick the right portfolio on this frontier? You have to think about the amount of risk that your organization is willing to bear, and then try to get as much return as possible for that, for that risk.
Great. Another question, Will. Where do you add liabilities into the mean variance model? It looks like the promises are missing from the model. How do you incorporate the decumulation phase?
Yeah, so I think there's a couple of parts to that question. So I'm not including liabilities here. I'm not doing a liability approach. This is just an asset-only approach. The same construct, again, if we wanted to add liabilities, the only difference is we would be looking at our risk as a risk net of the liabilities, the assets net of the liabilities, so the risk of the surplus. And we'd redefine that risk on the horizontal axis here, and we'd do the whole thing again. The decumulation phase, so that's a great question. So I think what that question is getting at is we have one strategy for the portfolio where we're accumulating wealth, we're accumulating assets. And then if we get to a point where, say, the pension plan is closed to new members and we're winding it down and basically paying out existing members, the strategy could change. Now, for an institution, what I would recommend is, just to keep things simple, if you're in the accumulation phase, and you think you're going to be in that for another 5 years, come up with a strategy that is running for 5 years, and have a 5-year horizon and think about what allocation makes sense to get you to that point you want to be in 5 years. And then as you get into that 5-year period, as time passes, step back and think about, okay, our scenario is changing, the environment is changing. Now we're going to think things through a little bit differently, and we're going to recalibrate our strategy for the decumulation phase. That's what I would recommend. I think trying to get into it and plan way in advance, how you're going to do the accumulation, and then 10 years from now, how we're going to do decumulation. I think it's hard to do, and it's very likely that something happens along the way that takes you off track, and you're going to have to end up revisiting things. But that's just my opinion. I'm not an expert on decumulation, phase strategies. I think that comes up a lot more in 401ks and kind of individual investing, kind of defined contribution plans. Most of the work that we do is with institutions who are thinking more about things in the way that I've described. Well,
great. Thank you so much. Great presentation. great questions and great responses. Thank you again for your time and your expertise on this matter. And finally, to the audience, thank you for joining us today. Our next webinar is scheduled for July 13th. It will be hosted by Aon, and the session title is Preparing for the Pandemic's Impact on Your Plan, Year 2. So with that, let me conclude. And again, thank everyone for joining us, and have a great rest of your day.
Thanks so much for having me. Take care, Hank.
Take care, Will. Bye-bye.